Index funds. Hey everybody, welcome back to Whiteboard Finance. My name is Marco and I'm here to help you master your money and build your wealth. Even if you're new to investing, you've probably heard of stocks and bonds, but after you do a little bit more digging in the personal finance and investing space, you start to hear about these things called index funds, mutual funds, and ETFs. The reason you're probably watching this video right now, other than for my incredible hairline, boyish good looks, and impeccable sense of humor, is that you just Google these terms to figure out which is best for you to invest in. So in this video, I'm going to give you a simple breakdown of the difference between index funds, mutual funds, and ETFs in order for you to figure out which one is best for you and your goals. As always, stay until the end of the video to hear my personal thoughts. Okay, normally I don't start my videos with an overview of what I'm talking about, but in this case, it actually makes sense to do so. The best example I can give for the similarities between mutual funds, ETFs, and index funds is essentially a group of people pooling their money together in order to buy a certain asset or group of assets. This is similar to offices pooling their money together to buy a lottery ticket and splitting the winnings, or a family pooling money together to buy a vacation property or season tickets to their favorite sports team, for example. So mutual funds, index funds, and ETFs allow investors to buy a basket of goods and services such as stocks, bonds, and other securities. The biggest difference, however, are the way that these things are managed. ETFs can be traded just like stocks. So right here, ETFs are traded on an exchange where mutual funds are not. They can be traded intraday, meaning normal market hours, just like a stock. Mutual funds cannot. These can only be typically traded at the end of the day based on their net asset value. But before we get into NAV and net asset value, before it gets too confusing, we'll touch on that later. So mutual funds are typically actively managed. So right here is active. ETFs, passive. So actively managed funds means that there is a portfolio manager and typically a team of analysts of human beings doing most of the decision making to choose what these funds invest in. This means they need to be compensated for that work, so you typically end up paying higher annual fees with mutual funds compared to an ETF. So if we go to the expense ratio section, ETFs are going to be lower, mutual funds are going to be higher, and we'll touch on those numbers here in a second. So ETFs, on the other hand, as I mentioned, are usually passively managed. They're usually based on a broad market index or a specific set of investment criteria. Since most ETFs are passively managed, the expense ratios, aka the amount of fees that you pay per year to own these assets, can be incredibly inexpensive, if not completely free with certain ETFs. So that's this section right here, management fees. We'll fill in the average numbers here in a second. So the average expense ratio for actively managed mutual funds is between 0.5% and basically 1%. Some are much higher. They can go all the way up to 2.5%, but they rarely exceed 2.5%. For passive index funds, the typical ratio is about 0.2%, but actually some of these are 0%. They can be up to the higher percentages, but on average, you're looking at 0.2%. That's a big difference. So for example, Vanguard's total stock market ETF has an expense ratio of just 0.03% at the time of this recording. This means that for every $10,000 you have invested, you only pay $3 a year in fees. If another fund has an expense ratio of 0.75%, look at how the fees compare. This may not seem like a lot, but once you reach $1 million in that portfolio, those numbers turn into $300 per year with the 0.03 and $7,500 a year with the 0.75% option. So before this gets any more confusing, let's jump into each one of these assets individually. We're gonna talk about mutual funds, index funds, and ETFs, but let me just fill out these last two sections here. So with ETFs, the transparency is very high. With mutual funds, typically it's lower, just based on how these things are regulated. And then the dollar amount minimum to be invested is very low. With fractional shares, you can buy $1 worth of an ETF if you really want to. With a mutual fund, there's typically a minimum to be able to invest in mutual funds, typically in the thousands of dollars, if that makes sense. So let's get into the next section of what is a mutual fund. Okay, so what is a mutual fund? The answer is in the actual name, mutual fund. Mutual funds are called mutual funds because they combine the funds of investors who mutually pool their money together. The goal of this money is to buy and sell securities as mentioned in the previous section of this video. When you invest in a mutual fund, you're not buying specific shares of specific companies like you would with Microsoft or Amazon, for example. You're buying shares of the actual mutual fund company itself. If this doesn't make sense to you, you should check out my Stock Market for Beginners video where I talk about the definition of equity and having equity in a company, or in this case, the mutual fund itself. So investors buy and sell their stakes in mutual funds at a certain price, aka the net asset value, NAV. For a very easy definition of net asset value, this is simply the mutual fund version that represents a funds per share market value, similar to a stock's share price. So when you see like Tesla trading at $1,000, for example, that's what the NAV is of a mutual fund. So net asset value is calculated by dividing the total value of all the cash and securities in a fund's portfolio minus any liabilities by the number of shares outstanding. So let's have a quick example. We have $95 million in securities under management, $5 million in cash. This gives us a total of $100 million. The fund has liabilities of $20 million, resulting in a value of $80 million. So here's a question for the audience. If the fund has 10 million shares outstanding, what is the NAV price per share? So if we know we have $80 million, assets minus liabilities, divided by 10 million, answer in the comments down below, what is the price per share? Okay, so I gave you some time to answer that. It is $8 per share. Okay, it's just 80 million divided by 10 million. There are many different types of mutual funds, such as fixed income, index, balanced, money market, international, specialty funds. There's a bunch out there. The biggest advantage of mutual funds is that they have broad diversification. They have professional management, and they have a variety to choose from, and sometimes a low barrier to entry in terms of minimal investment amount. Sometimes it could be as little as $1,000 or $2,000. The biggest disadvantages to mutual funds are high fees, no FDIC coverage in most cases, and hard to compare apples to apples like you would with stocks, for example. Again, mutual funds do not trade on exchanges as regular stocks and ETFs do. Speaking of which, let's jump into ETFs next. Okay, so what is an ETF? An ETF stands for Exchange Traded Fund. This is a type of asset or security that tracks an index, sector, or specific type of investment. Think of an ETF as a basket of assets, a basket of X, for example. So a basket of stocks, let's say that, you're buying an ETF that trades stocks. One share of an ETF can contain hundreds or thousands of different assets, such as publicly traded companies. So you're owning hundreds or thousands of stocks within your one ETF. Does that make sense? It's a basket of X. So let's use VTI as an example again. VTI is an ETF that seeks to track the performance of the US Total Market Index. It is passively managed and contains 4,100 different stocks with an expense ratio of just 0.03%, as mentioned earlier. An ETF is called an exchange traded fund because it's traded on an exchange just like stocks are. They trade intraday, as we mentioned in the first slide. Some of the benefits of owning an ETF is that they are liquid. This is a little raindrop right here, a little drip, drip, you know, drip, drip. I'm gonna get a copyright strike, never mind. So they're more liquid than mutual funds, meaning that it's easier to buy and sell them throughout the day. Remember, mutual funds can typically only be traded once per day at the end of the day. ETFs can be traded during regular market hours. There are many different types of ETFs, for example. You can have bond ETFs, stock ETFs, industry or sector specific ETFs, commodity ETFs, currency ETFs, inverse ETFs. I'm not going to go into each of these specifically because some of them, obviously common sense based on their name. But if you want to dig further, there's plenty of information online on this. So the biggest advantages to ETFs are that you have access to many different stocks across various industries. You have low expense ratios, so types, low fees. You have a ton of diversification, and then you also have sector-specific ways to invest if that's what you're looking for. So speaking of sector-specific ways to invest, let's talk about index funds next. Okay, so what are index funds? So this is really going to cook your noodle. An index fund is actually just a variation or a type of mutual fund and or ETF. An index fund is a portfolio of stocks or bonds designed to mimic the performance of a specific market index. So for example, if you wanted to mimic the S&P 500, you can do so with an index fund called SPY, S-P-Y. Index funds, just like ETFs, have lower expense ratios and fees than actively managed funds. So instead of a portfolio manager actively picking stocks and trying to time the market, this manager will build a portfolio trying to mirror a particular index and do that passively by creating an index fund. Because the index fund managers are simply replicating the performance of a benchmark index, they do not need the services of research analysts and others that assist in the stock selection process, as we mentioned earlier. There's no need for 5-figure year-end bonuses to analysts who work 80+ hours a week. They have no social life, and they consider quitting their job while having an existential crisis about why they chose to work in finance in the first place. But then they bought their Rolex Submariner and all was well in the world again. So for example, an index fund tracking the Dow Jones Industrial Average, which is an index itself, would invest in the same 30 companies that make up that index in order to mimic those results. Make sense? So the advantages of index funds are incredibly low risk through diversification, similar to ETFs. They have low expense ratios, they have strong long-term returns, which have been recorded and documented and proven, and they're ideal for passive investors. Some of the cons to index funds are that they are vulnerable to market crashes, there is no human element, and their gains are limited to the specific index that they're trying to replicate or recreate. Okay, so as always, I give my thoughts at the end of the video. This is not scripted, it's just off the cuff freestyle. I will say that for most passive investors, index funds or ETFs are pretty much all you need. There's some people that push mutual funds, but when it comes to the results and past history of results, those are no indication of future results. So you're gonna be paying higher fees for actively managed funds. Just know that's what you're getting into. But at the end of the day, most people will be well served with just a sound index fund or ETF. Some people like to rotate sectors. Some people like to rotate into commodities, especially when inflation is high. I wanted to buy a uranium ETF like a year and a half ago, 2 years ago, after talking with my friend George Gammon. I didn't do it, and now it's up like 3-4x, okay? And I feel dumb, but I should have pulled the trigger, but I didn't. However, I will say that, like the example that I gave with VTI, the Total Stock Market Index Fund, there's a mutual fund equivalent, VT-SAX, or an index fund equivalent. But at the end of the day, the expense ratio of these ETFs is just so hard to beat. I may have glossed over it earlier in the video, but when your portfolio actually grows after you invest for 20, 30, 40 years, and you're in the millions of dollars, especially with inflation, these fees are gonna eat you alive, and that's why low expense ratios really do make a difference later on. So as always, I hope this video was valuable for you. Please share it with a friend. Please click the like button gently. Don't smash it, don't kill it, don't destroy it, don't break your laptop. Just gently click the like button and share the video. I'd greatly appreciate it. Thank you so much and have a prosperous day. Oh, dude, this fake money, check this out. Okay. Come on. Dude, my mom thought this was real. It was sitting on my, island in my kitchen, and I had like 3 of these stacks. She's like, "Why do you have 30 grand on your kitchen?" I'm like, "Dude, I'm slinging. I'm making finance. Let's go."